How to short a stock? We're going to talk about 3 different strategies and what are the pros and cons of them. If you like the information, please like and subscribe. Do keep in mind our Bear Trend Trader course, which is based on a pump and dump trading system. Get in at the highs and capture big rewards as price goes lower. You can get these products and more at stockchargetrading.com. Watch to the end for a special offer. Get the link in the description. Bear call vertical spreads. What are they and how do they work? Well, we're all familiar with GameStop, where Wall Street Bets put a short squeeze on big hedge funds shorting the shares of GameStop. And it really worked for a long time because they made tons of profit as price went down. So how did the system work? They sell GameStop stocks up here, and as price goes lower, they buy it back. The question is, what are the requirements of shorting stocks? The standard margin required is 150%, which means you have to provide over 50% of the current stock shares. If you want to short 100 shares of a $10 stock, you will have to put $500 as margin in your account for protection if it keeps going up. It seems backwards, right? We want to find the dip on things and buy going up. But did you know, in order for you to buy a call option to get into that long trade, somebody has to sell it to you. The Beginner's Guide to Buying Calls on Investopedia. When you buy a call, you pay an option premium in the exchange for the right to buy the shares at a fixed price, strike price. And so here is the word premium. You're paying that in order for somebody to sell you that right. Now the flip side, selling calls. When you sell them to the purchaser will pay you the premium for you telling them you'll give them the right to be able to buy the stock at the agreed upon price. So again, you're collecting premium. So when buying an option, a lot of times we just consider the price movement. Is it going to go up? We're going to buy calls. If it's going to go down, we're going to buy puts. But when you walk out of Walmart, who made more money, you or Walmart? That's right, Walmart did, because they sold you a product. So think about this. When you're buying a call option or put option, you're providing money to somebody like Walmart who's selling you an item. Implied volatility consists of that margin that they're charging you from where they bought it to where they're selling it to you. They sell it to you at 80 and they buy it back at a lower price to pay off the merchant. They put an extra premium on things like vegetables or other goods that will expire because they understand time decay. When all we want is price to go up or down, we're not really thinking about anything else. This is next level to be a seller of options. Let's talk about the benefit of implied volatility when selling options. If you sold somebody the right to have their call option with a low implied volatility, that means as implied volatility goes up, you're losing money, they're making it. But if you sell somebody the right call option or put with high implied volatility and that implied volatility goes down, you make the money. So my question is, in options, do you want to give somebody else money or do you want to collect the money? Same with expiration of time decay. Do you want to give somebody else money to hold on to that option until expiration, or do you want to collect the money? Let me put these words into action for you. QQQ. We're up, all-time highs coming into resistance. So do you think price will go down from here? You would probably buy puts. So if we come to our option chain and go to single, puts, ask column because we're buying, and we'll go at the money. For me to buy the right of this put, it would cost me $672. If it went to 0-0, which that will not happen, I would make $35,000. Seems like a good ROI, but again, nearly impossible that that's going to happen. I do need the price to move down to 357 just so I can break even. And that's basically telling me the premium of this thing. $357 where we're at $363 right now. So the odds are already against me. So what would it be like if I sold calls? Well, here we are, and last time we did the ask, this time we're going to do the bid. So if I come straight over at the money where we're going to buy our puts to the call side, because I'm selling calls, I would use the bid column. Click on that, and here's my new layout. The cost of my puts was $670. On this one, it would be over $7,000, and it doesn't even seem worth it because my max profit would only be $600. Now, the nice thing is price could even go up, and I'll potentially make that profit because my break even is $370 versus where price is now, $363. So that's a lot of money. Well, just by doing one thing, it's going to totally change the trade. We already viewed on how to sell the call option. Now, if we purchase a call option at a higher strike price on the same underlying asset with the same expiration date, we create a bear call spread. We already had this position on minus sell the call at the money, and we added this position plus means bought, the higher strike price call for protection, giving us a spread trade. And let's look at the results of the difference. For one contract, it's only $43. The max profit is over 100% at $57. And the break even is $364.50, which means price could even go up from here and we would still make money. So let's look at what we just did. We could have bought puts right here, costing us around $700, and price would have to go below this break even. Second scenario is we could sell naked calls right here. It would cost us a lot of money, but as long as price stayed under this break even, by the day of expiration, we would make money. The last bear call spread, we sold calls right here, then we bought calls up above it, meaning if price roars up, we would be protected. Unlike when we sold the calls, it said max loss infinite. What does that mean? Once it got above $370, you would have to keep increasing that $7,000 that you spent on selling those call options. That could get expensive. So for me, out of these three scenarios, I like bear call spread the best. Price can move up and down, but as long as by expiration it's below break even, you make over 100% profit. Because remember, instead of paying out every day as that time decay takes away your profits, you're collecting it, and you're collecting the premium of the implied volatility, and price is going in your direction. So with bear call spreads, you have three things working in your favor to make you money. Don't you want to be a seller instead of a buyer? I mean, when TD Ameritrade and everybody else says vertical credit spreads are your high probability trades with probabilities of success around 80%, giving you the perfect trading strategy. I hope you learned a lot of things. Because you watched all the way to the end, I'd just like to say thank you. When going to Stock Charge Trading website, you can use this special code. It'll give you 10% off on any product. And if you're a big fan of indicators, all of our courses and indicators match together. Like the polynomial, giving you the perfect trend continuation entry by the dip, also built in giving you targets to take profit. Along with the W pattern indicator, giving you bearish entry points, printing right on your screen. Match it up with the polynomial, and you've got a real winning system. You can use that 10% code on any of our products or group them all together and save more money. I wish you the best in trading.